And thank you to Terry for coming here today to give us a presentation.
All right. I won't keep you too long. This is not going to be nearly as exciting as the Taekwondo equipment. It's a bit dry. So this is kind of a reprise of a workshop we did a few years back. So I guess we're dusting off and resurrecting the educational workshops. This one we actually would normally do in an hour. So this is kind of the Coles Notes version on preferred share terms. But we'll go through it. You can ask me questions later. But this is real, and I apologize if it's too basic for some of you more experienced investors, but just asked me to kind of go through the basics, soup to nuts. So I'm going to stand over here because I haven't memorized every word on this thing. So the first thing to remember about term sheets is they're non-binding. You're not signing a contract. It's non-binding. It's purely an expression of intent. However, there are some sections that the current York Angels standard term sheet identifies as being enforceable or binding, right? The exclusivity, in other words, companies cannot go and shop a deal around once we've signed a term sheet. Obviously, confidentiality. There is a clause in there that talks about expenses, that fact that the company will pay the legal costs of the investors at closing, and then governing law. The challenge here is, in theory, these sections are binding. In practice, I've never seen them enforced ever. So it's more just to try and keep the company honest, as opposed to it being something you're going to go and do litigation with. There's been lots of companies that have shopped deals around, signed term sheets, moved on to something else, and it's really tough. You have to have damages anyways or losses to enforce something like that. But again, you should still be aware that those sections of the term sheet are binding, but everything else is non-binding. Okay, so the next section, and York Angels has two standard term sheets. One is a convertible note structure and one is a preferred share structure. This is the more common, so that's the one we're going to talk about today. We can talk about convertible notes at another day, I think. So preferred shares are a different beast than common shares. They have preferential rights to common shares, so it's kind of a share structure with all kinds of bells and whistles. They rank senior to common shares with respect to dividends and liquidation proceeds, and we'll talk about that in a minute. There's something we call a liquidation preference in those preferred shares. Preferred shares get to participate in dividends prior to common shares, and dividends sounds really glorious, but in practice, dividends are almost never issued for early stage startup companies because it's at the discretion of the board. But if dividends are going to be paid, then the preferred shareholders stand first. Preferred shares are convertible on a one-to-one basis into common shares. So at the end of the day, on a liquidity event, ultimately you want everything converted into common shares. And they have equivalent voting rights to common shares. So it's really just all the good attributes of a common share plus a lot of extra additional attributes. There's anti-dilution protection, which we'll talk about in a minute. What I call supermajority approval rights. So there's certain things preferred shareholders or the company cannot do without the approval of preferred shareholders. So the standard York Angels term sheet uses a 2/3 majority. So 2/3 of the preferred shareholders need to approve certain things that management or the company or the board wants to do. And we'll talk about that. And then there's some other things like registration rights and rights of first refusal. So again, in general, we just want you to understand that this is a different breed of share. These are encapsulated in the Articles of Incorporation or the Articles of Amendment. So there's specific share terms that are built into those articles. Okay, so a really fundamental term is pre-money valuation. You've probably heard it lots of times. I'm sure most of you know what that means. But just for those of you that are a little newer to the game, pre-money value means the value of the company before you're making that investment. So in the example I've got on the board here, a company could have a $2 million pre-money value. If they have a million shares outstanding, that's a $2 share price. Really simple math. And the way you calculate an investment is if someone is going to make a $500,000 investment, you subscribe at $2 a share, you're going to get 250,000 shares, and the post-investment float of shares will be 1.25 million shares or 2.5 million. So you always add the investment to the pre-money value. So that's called the post-money valuation. So in that scenario, that $500,000 investment would have gotten the investors a 20% stake in the overall business. So really simple math. The other term you might be hearing is, something on a fully diluted basis. What that means is it assumes that all the different types of securities that the company has have been converted into common shares. So it includes all outstanding common stock, all outstanding preferred stock, any stock options. So if there's an employee stock option pool, that gets calculated into the fully diluted cap table, as well as outstanding warrants. And for those that don't know what a warrant is really just like an option. It's a contract to buy shares at a specific price for a certain period of time. Okay? But again, so generally when you see a cap table, it's going to be on a fully diluted basis. So if a company has 3 million shares outstanding, that includes, on a fully diluted basis, that includes all those different categories. Okay, dividends. Again, dividends sound attractive, but rarely are they baked into or ever issued on a early stage company. There simply isn't the cash flow, and any cash that's available, ideally investors want that to be pumped back into the company. But the York Angels term sheet right now does call for the ability to bake in a dividend. So a dividend could be 5% or whatever coupon rate you think. They're non-cumulative, so it's only as declared by the board. So this is not a type of share where you're getting your 5% or 10% return or a dividend every year. It's not like more mature companies that have different types of securities. But if they are declared by the board, then the preferred shareholders take priority to the common shareholders. Okay, liquidation preference. So this one is really important. A liquidation preference is in the event of a change of control. So sale of the business, a liquidation of the business, a merger with another business where a majority stake is being taken. The preferred shareholders get a one-time liquidation preference. What that means is if in that previous scenario, if the preferred shareholders invested $500,000 and the company gets sold for, say, $5 million, the first $500,000 comes off the top and goes to the preferred shareholders. So this is an effective tool to actually increase the rate of return relative to someone who just invested in common shares. So in that scenario, $500,000 would come off the top, would go to the preferred shareholders, and then the remaining $4.5 million would be distributed ratably or pro rata, as they say, amongst all the other shareholders, including the preferred shareholders. So you sort of get two kicks at the can when you have a liquidation preference. I don't know how often that's used in deals with York Angels these days, but it's a bit of a draconian tool, but it's a very effective tool to increase the rate of return. Okay, anti-dilution. There are all kinds of different types of ways to calculate anti-dilution. The standard term sheet uses what's called a broad-based weighted average basis. I'm not going to take you through all this math. I think you're too tired for that. But suffice to say, it protects the preferred shareholders in the event of a down round. So if you invested at a valuation of $2 million, for example, and then a year later, company's struggling, has to do another round and does it at $1 million, you're going to get topped up. Okay, so it protects you from the company doing dilutive or down round financings after the fact. So in this case, if the company had done a down round at $1 million from 2, you'll see the conversion rate at the bottom is you'll actually get 2.59 shares for every share that you originally bought. Okay, so this is a really good, effective tool if a company is struggling a little bit and having to do kind of emergency down rounds or low valuation rounds. And it's also a huge incentive for the company not to do a down round. Okay, redemption. This is essentially a put option, if you know what a put option is, where after 5 years, the preferred shareholders can go to the board or go to management and say, I want you to buy my shares back at what I paid. You need 2/3 majority of the preferred shareholders, and in some cases you can build it into the term sheet that there's a coupon or an interest rate baked in. And then in the standard terms, if the company is unable to redeem, if it's struggling, I mean, the real situation is Generally, after 5 years, company may be struggling or not performing. You say, I want to redeem. It probably doesn't have the cash anyways. Otherwise, it wouldn't be struggling. But the preferred shareholders can essentially turf management, elect a majority of the board, create a liquidity committee, and this is a very heavy-handed provision. Imagine we don't get it very often, or don't ask for it very often, but it is something that you can use. I'd say this is probably used a little more for later stage companies that are raising larger amounts of capital that actually have some assets that you can call on if there's a problem. But for early stage tech companies, this is a tough provision to get into the term sheet. So the standard term sheet also talks about board rights and observer rights. A board of directors, there's no recipe for it. In some cases, you want a 5-man board, you might have a 10-man board or a 10-person board. But typically, York Angels ask for at least one nominee on the board and also occasionally an observer. So an observer is someone that simply attends board meetings but has non-voting rights. Okay, so again, I've seen typically 3, 4, 5-person boards, and the preferred shareholders have one nominee to that board. So I think it's important that the preferred shareholders have someone at the board, but it's tough to have control of the board at this stage, especially if you're a minority investor. That really won't fly generally. And the term sheet also calls for having D&O insurance, liability insurance at the company's cost. Okay, there's a bit of a bucket here of right of first refusal, co-sale, preemptive rights. So preferred shareholders have the right of first refusal for any subsequent financings. So if the company wants to do another round, most typically they're going to come back to their existing investors anyways. It's a lot easier than going to some new people to the table. They also have the right to participate in any sale of shares of the company. So if the management wants to sell the company or sell a portion of the shares to someone else, then the existing investors or preferred shareholders can participate. And you also have a preemptive right up to your pro rata share of equity. So lots of ability baked in to participate on future rounds of financing. So you're not going to miss the boat, so to speak, if there's a subsequent round of funding. And let's say the company is doing really well, like some of the investee companies, you want the ability to participate and follow on rounds and top up your investment. Okay, drag along rights. To me, this is really, really critical. You can't allow 1 or 2 shareholders or a small minority of shareholders to hold up a sale of the business or a merger or a major sale of control of the business. So a drag along forces all the small shareholders to be dragged along in the event of a sale. As long as the board approves the sale and 2/3 majority of the preferred shareholders approve the sale, then everyone else gets dragged along. So this is built so that small people can't essentially freeze the company from doing a transaction. Okay. And then there's a bunch of protective provisions. So what this basically means is the company needs consent of the preferred shareholders to do certain major activities. In this case, it's required 2/3 majority of the preferred shareholders, and everything from a liquidation event, issuing new securities, recapitalizing the company. So if the company wants to change the articles of incorporation and create new class of shares, that's going to require pref shareholder approval. Material changes to the business. So if the company is in the software business and tomorrow wants to become a real estate developer, they need approval of the preferred shareholders. Typically, budgets are approved, or sometimes just expenditures in excess of a certain threshold. The company can't spend more than, say, $50,000 on any single expenditure beyond what was budgeted for. But that's sort of normal course board approval thing. So this can have as many different customizable features as you want. It really is very dependent on the situation and the company. Challenge there for the entrepreneurs is if you have too many handcuffs on you, it's hard to run the business. So I think you need to use these kind of provisions judiciously and not try and overburden the entrepreneur or the company with too many restrictions and having to come to the preferred shareholders. At the end of the day, in my opinion, preferred shareholders should be there to help the company when it needs it, add advice, but not babysit the company and micromanage. Okay, and if a challenge, if the company's not performing, then there's other ways to kind of manage the board and the company. And then the last section is really closing conditions. So some people that are new to this are hesitant to sign term sheets. They don't even know how it works. But generally, the York Angels or the Angel Group signs a term sheet on behalf of investors. Again, it's non-binding. They're not binding everybody to invest. It's simply an expression of the business intent of the parties. Typically, a lead investor or someone or the largest investor will sign the term sheet. The other thing to note is you're not investing in a pool with a bunch of other people. You're making your own investment as an individual. So it's not like if 10 people go in on a deal, all 10 of you, hold all those shares together, which means that's sort of the joint and several term. You're making your own investment in your own either holding company or in your own personal name. It's not a company or a partnership. Having said that, sometimes investors will pool their resources and do a single purpose corporate entity because sometimes the company doesn't want too many shareholders or there's other reasons. But generally, you're investing on your own. And then, so closing the deal is subject to a lot of things. So the other thing you have to realize is once you sign the term sheet, then the real work starts because that's when you're really doing your due diligence. Okay, so it's incumbent on every investor to do their own due diligence. There's lots of help around the table. There's a lead investor, but at the end of the day, you need to be satisfied that you've done your due diligence and you're comfortable, okay? And there's no recourse back to York Angels or anyone else if you get burned or you didn't do your homework, okay? And then of course, the term sheet or the closing is subject to, there's basically two primary legal documents, a subscription agreement, which has all kinds of terms in there that talk about what you're buying, all kinds of restrictions on the company, and then there's a shareholder agreement. Those are the two main driving legal documents. There's about 50 other ones that lawyers get paid to do, but those are the main two that you really need to look at. And again, your lawyers are there to negotiate those, and the term sheet is sort of a guide on how those documents are papered. But again, they're a lot more comprehensive. And then sometimes you'll have management sign employment agreements. You'll have a provision that says that all the employees have to sign NDAs. That's pretty common. But really, it's the legal documents get done right at the end, after you've done your due diligence and after the business deal and the term sheet's been negotiated. So that was a whirlwind tour of our beautiful term sheet. I don't know if you have any questions. Like I said, normally we would do this in an hour and a half workshop and go in more detail, but hopefully this gave you a bit of an overview on how term sheets work.